Hi, I'm Evaldo Albuquerque, and today I want to talk to you about stop losses. I'm going to show you two simple rules that can help you set your stop losses. If you don't know what is a stop loss, it's simply an automatic order to close the trade if the price reaches a certain level. So we're going to take a look at the last two trades I recommended in my research advisory service FX Breakout Alert. So here's rule number one. If you are buying the currency pair, you should set your stop loss below the support area. A support area is an area where there has been some buying pressure before. It's an area where traders tend to buy the pair. Usually when a price violates a support line and moves below a support line, it tends to move a lot lower. So if you are buying a currency pair, it makes no sense to keep the trade open if the price moves below the support line. And that's why I like to use rule number one. So in this case, we are looking at a daily chart of the pair USD TRY. And this is the dollar against the Turkish lira. So in my advisory service FX Breakout Alert, we went long the pair around here, and we set our stop loss below 1.74 at around 1.73. And we did that because the support area was around 1.74. As you can see here, every time the pair tried to move below 1.74, it was not able to, because there was a lot of buying pressure around that level. You can see in this day, and these two other days, there was a lot of buying pressure and the pair was not able to move below 1.74. And that's why we decided to buy the pair and set our stop loss right below that support line. In this case, we were able to close the trade a few days later for a profit of about 32%. So this is how to use rule number one. If you are buying the currency pair, you set your stop loss below the support area. Here's rule number two. If you are selling the pair, you should set your stop loss above the resistance area. Resistance area is simply an area where there is selling pressure. It's an area where traders tend to sell the currency pair. Usually when a price violates a resistance line and moves above the line, it tends to move much higher. So if you are selling the pair, there is no reason to keep the trade open if the price moves above the resistance line. And that's why I like to use rule number two. In this case, we are looking at a daily chart of the pair ZAR-JPY. That's the South African Rand against the Japanese yen. And in this case, this was the last trade recommended in FX Breakout Alert, and we actually went short here, around here, and we set our stop loss at 11. And the reason we did that is because notice that at around 10.90 there was some selling pressure around 10.90. So this was the resistance area, 10.90. Notice in this day there was some selling pressure, this day again, and once again here there was a lot of selling pressure between 11 and 10.90. So the original premise of this trade was that this uptrend was coming to an end, and I came to that conclusion by using other technical indicators. So we set our stop loss right above the resistance level because we knew that if the price were to move above the line, I would have been wrong. But that was not the case. The pair actually moved lower, and we were able to close this trade a few days later for gains of about 110%. So this is how to use rule number two. if you are selling the currency pair, you should set your stop loss above the resistance area. So I hope this video helps you next time you are setting your stop loss. Thanks for watching, if you'd like to know more about FX Breakout Alert, please see the link below.